So, you want to own Amazon. Not an Amazon package, not a Prime subscription, not a few shares sitting quietly in your investment portfolio. You want the whole company, every fulfillment center, every delivery station, every robot moving shelves across warehouse floors, every package traveling down a conveyor belt, every Prime subscription, every seller paying to reach customers, every advertisement appearing beside a search result, every movie streaming through Prime Video, every cloud server running through Amazon Web Services, every truck, every aircraft, every data center, every marketplace transaction, everything. At first, it sounds like the ultimate billionaire business, because somewhere in the world right now, someone is clicking buy now. Maybe they're ordering a laptop, a toothbrush, a television, a book, a refrigerator, a phone charger, a birthday gift, something they need tomorrow, something they probably could have bought somewhere else, but didn't. They opened Amazon, searched, clicked, paid, and moved on with their day. The entire transaction may have taken less than 30 seconds. Simple, effortless, almost invisible. But behind that single click, a machine begins moving. And that machine is one of the most complicated business systems ever created. Now imagine this. It's 6:17 on a Tuesday morning. You're still asleep. Then, your phone rings. You ignore it. It rings again. You reach across the bed and answer. On the other end is one of the largest investment banks in the world. The voice is calm, professional, and unusually direct. We've been authorized to approach a very small group of potential buyers. You sit up. Then comes the sentence. Amazon is available. Silence. At first, you assume you misheard. You didn't. The board is willing to entertain an offer. Major shareholders are prepared to negotiate. Law firms are already working behind closed doors. Financial institutions are assembling teams. And somehow, your name is on the list. The asking price? Several $trillion. Not several million. Not several billion. Trillion. With a T. Your advisors immediately begin making calls. Banks start running models. Sovereign wealth funds request meetings. Governments quietly begin asking questions. And somewhere inside a conference room, a document is placed in front of you. All you have to do is decide. At first, the answer seems obvious. You're buying the world's most famous online shopping machine. Millions of customers, millions of products, a globally recognized brand, one of the most powerful digital marketplaces ever created. What could possibly go wrong? Well, almost everything. Because before a single dollar of profit reaches your bank account, before you celebrate your first day as owner, before you even finish reading the acquisition documents, someone, somewhere, has already clicked buy now, and they want their package tomorrow. That's your second hook, because the moment you own Amazon, the clock starts ticking. A customer in London orders headphones. A family in New York orders diapers. A student in California orders a laptop charger. A business in Texas orders office equipment. A customer in Tokyo places another order. Millions of decisions, millions of expectations, and behind every one of them, a promise. Fast. That word changes everything, because customers don't care that one of your fulfillment centers had a problem. They don't care that a truck broke down. They don't care that a storm delayed a flight. They don't care that a warehouse lost power. They don't care that a seller sent the wrong inventory. They don't care that your forecasting software miscalculated demand. They clicked. You promised. Now deliver. Imagine what happens after one order. A customer taps the screen. Payment is authorized. Software identifies the product. Inventory systems locate it. Maybe it's sitting in a fulfillment center hundreds of miles away. Maybe it's already positioned near the customer because your algorithms predicted demand before the order happened. A worker receives instructions, or a robot moves inventory. The item is picked, packed, labeled, sorted, transferred, loaded, moved through another facility, placed on a truck, possibly moved by air, sent to a delivery station, assigned to a route, and finally, dropped at the customer's door. All because someone moved their thumb half an inch across a screen. That's what you just bought, not a website, a physical machine triggered by digital behavior. And here's where things become strange, because the website everyone recognizes may not be the most important business you're buying. Hidden beneath the shopping carts, cardboard boxes, discounts, and delivery vans is another empire, one most ordinary customers rarely think about: cloud computing. Imagine waking up as the owner of Amazon and discovering that some of the world's businesses depend on infrastructure your company rents to them. Startups, large corporations, streaming platforms, government organizations, developers, financial institutions, technology companies. They need computing power, storage, databases, networking, artificial intelligence infrastructure. Instead of building everything themselves, they can rent it from you. That's Amazon Web Services. And suddenly, the company you thought was an online retailer starts looking very different. Then you discover another business: advertising. A customer searches for running shoes. Several brands want attention. Who appears first? Who gets seen? Who gets clicked? Visibility has value. And when millions of customers arrive with purchase intent, brands are willing to pay to reach them. Now, you're not simply selling products, you're selling access to customers. Then comes Prime. At first, it looks like a shipping membership. Pay a fee, receive benefits. Simple. Except Prime does something much deeper. Once someone pays for membership, their behavior can change. They may shop more often, check Amazon first, watch entertainment, use additional services, stay deeper inside the ecosystem. A shipping program becomes a loyalty machine. Then comes the marketplace. Millions of sellers want access to customers. Some store inventory with Amazon, some pay fulfillment fees, some advertise, some use logistics services, some compete for visibility. Now think about what you've created. Customers attract sellers. Sellers increase selection. More selection attracts more customers. More customers attract more sellers. And sitting in the middle is the platform owner, you. This is when you finally understand what you've bought. Amazon isn't one business. It's a marketplace, a logistics company, a cloud computing company, an advertising company, a subscription company, a streaming company, a hardware company, a grocery business, a data company, an AI infrastructure company, a fulfillment network, and each piece can strengthen another. That's the opportunity. It's also the danger, because when you own one business, you manage one battlefield. When you own Amazon, you're fighting wars everywhere. Retail margins can be thin. Warehouses are expensive. Delivery is expensive. Workers are expensive. Aircraft are expensive. Data centers are expensive. Artificial intelligence is expensive. Entertainment is expensive. Cybersecurity is expensive. Regulation is expensive. And customers want everything cheaper and faster. Think about that. Your greatest competitive advantage, speed, is also one of your greatest expenses. The customer loves one-day delivery. You have to pay for the machine that makes one-day delivery possible. So today, we're going to put ourselves in the position of the person making one of the biggest business decisions imaginable. Together, we'll answer the questions every billionaire, every sovereign wealth fund, and every institutional investor would ask before attempting to own Amazon. How much would it actually cost? What are you really buying? Where does Amazon make its money? Why can a company move billions of products and still care about tiny improvements in efficiency? Why might cloud computing be more important than the shopping website? What happens if regulators decide Amazon has become too powerful? What happens if customers stop paying for convenience? What happens if AI changes online shopping? And perhaps the biggest question of all, would owning Amazon be one of the greatest millionaire decisions ever made? Or would you be buying the world's most expensive promise to deliver everything, everywhere, on time? Before we find out, you enjoy exploring the economics behind the world's biggest companies, industries, and investments. Subscribe to Millionaire Decisions. And here's today's question. If someone handed you enough money to buy Amazon today, would you take the deal? Or would you invest those trillions somewhere else? Tell me your decision in the comments. Now, let's find out what owning Amazon would actually cost. What it really costs to own Amazon. So, you've made your decision. You want Amazon. The bankers have been called. The lawyers are working through the night. Institutional investors are studying the deal. Governments are watching. And now, someone slides the first document across the table. At the top is a number so large that buying Amazon isn't really a billionaire transaction. It's a global financial event. Let's start with the obvious question. How much would Amazon actually cost? The first answer seems easy. Look at the stock market. Find the company's market capitalization. Pay that amount. Done. Except, that's not how buying an entire public company works. Because the moment you announce that you want complete control, everything changes. Shareholders don't have to sell. Some will demand more. Others may refuse. Traders speculate. The stock price reacts. Regulators intervene. Politicians ask questions. Competitors prepare. And suddenly, the number you saw on a financial website becomes only the opening bid. Suppose the company is valued somewhere around the multi-trillion-dollar range when you make your move. To convince enough shareholders to sell, you may need to offer a substantial premium, 10%, 20%, maybe more. And when the starting value is measured in trillions, a small premium becomes enormous. A 20% premium on a $2 trillion company, that's another $400 billion. Not for a new warehouse, not for AWS, not for a fleet of aircraft, just the additional amount needed to make your offer more attractive. The premium alone could exceed the value of many famous corporations, and you still haven't taken control. Then comes financing. No individual billionaire has several trillion dollars sitting in cash. Wealth doesn't work that way. The richest people hold shares, businesses, real estate, investments, assets. So a complete acquisition of Amazon would likely require a financial coalition unlike almost anything in corporate history. Global banks, sovereign wealth funds, pension funds, institutional investors, private capital, perhaps strategic partners, and immediately, you encounter the most dangerous word in acquisitions: debt. Imagine borrowing an enormous portion of the purchase price. Now, Amazon doesn't simply need to grow, it needs to generate enough cash to support one of the largest financing structures imaginable. Interest payments could reach extraordinary levels. A small increase in borrowing costs could mean billions more in annual expense. And suddenly, a company famous for investing aggressively in the future might be forced to protect cash for lenders. That's the paradox. You can buy an extraordinary company and damage it with the method you use to buy it. But suppose you've solved the financing. The money exists, the banks agree, the investors sign. Now comes a problem. Money cannot easily solve. Regulation. Because you're not buying a bookstore, you're not even buying a retailer. You're attempting to take control of a company connected to commerce. Cloud computing, advertising, logistics, entertainment, digital marketplaces, artificial intelligence, consumer data, government customers, and critical technology infrastructure. Regulators would ask, who is the buyer? Where did the money come from? Could the transaction reduce competition? What happens to third-party sellers? What happens to cloud customers? What happens to consumer data? Could one owner gain too much influence over digital commerce? What are the national security implications? At this scale, the purchase is no longer merely economic, it's political. But imagine, against all odds, the deal closes. Congratulations, you own Amazon. Now comes the expensive part, keeping it alive. Let's start with fulfillment centers. Most customers see a cardboard box. You see the building behind it. Massive facilities filled with inventory, conveyor systems, robotics, scanning equipment, packaging stations, sorting systems, security, fire protection, software, maintenance crews, workers, electricity, and enormous amounts of capital tied up in infrastructure. A modern fulfillment center can represent a huge investment before it processes its first meaningful wave of orders. Now multiply that across a vast network. Different countries, different regions, different customer densities, different labor markets, different regulations. The closer inventory sits to customers, the faster you can deliver. But positioning inventory close to customers requires more infrastructure. Speed has a physical cost. Then comes sorting centers, delivery stations, air hubs, trailers, vans, aircraft, contracted delivery capacity, route planning systems, last-mile operations. Every step exists because moving a product from a shelf to a doorstep is far harder than displaying it on a website. This is the great illusion of e-commerce. The internet makes the purchase feel weightless. The product is not. A sofa still weighs what a sofa weighs. A refrigerator still occupies space. A television can still break. A package can still be lost. Rain still falls. Traffic still exists. Fuel still costs money. Drivers still need time. The digital order may happen in milliseconds. The physical world refuses to move that fast. So Amazon spends enormous amounts of money trying to make it feel like it does. Now imagine peak season. Millions of customers suddenly want more products. Your normal network isn't enough. You need temporary capacity, more labor, more transportation, more sorting, more delivery routes, more inventory positioned correctly. Forecast too little, and packages arrive late. Forecast too much, and you pay for capacity you don't need. That's the game. Build for average demand, and peaks can overwhelm you. Build permanently for peak demand, and expensive assets may sit underused. Then comes labor. This is one of the largest and most complicated responsibilities you're buying. A vast workforce across different functions, warehouse operations, technology, corporate roles, cloud infrastructure, customer service, delivery-related operations, engineering, sales, security, media, advertising, management. Now imagine adjusting that workforce as demand changes. Hire too slowly, service deteriorates. Hire too aggressively, costs explode. Automate too quickly, you create technical, political, and labor challenges. Automate too slowly, competitors become more efficient. Every choice creates another trade-off. Then come returns. This is where e-commerce becomes painful. A customer buys 3 shirts, keeps 1, returns 2. From the customer's perspective, convenient. From your perspective, reverse logistics. The item travels backward. It must be received, inspected, classified, possibly repackaged, restocked, discounted, liquidated, or written off. You paid to move the product toward the customer. Now, you may pay. That's why a sale isn't always the end of a transaction. Sometimes, it's the beginning of a second logistics journey. Then comes fraud, fake accounts, stolen payment methods, counterfeit products, false returns, seller manipulation, review abuse, account takeovers, bots, cyber attacks, marketplace scams. The larger the platform becomes, the more attractive it becomes to people trying to exploit it. So you need systems, machine learning, human investigators, security teams, payment controls, seller verification, customer protection. Every layer adds cost, but without trust, the marketplace weakens. Then we reach AWS, and now the scale changes again. Cloud computing sounds invisible. It isn't. Behind the word cloud are physical data centers, land, servers, networking equipment, specialized chips, cooling, electricity, backup systems, fiber connections, security, maintenance, and continuous upgrades. These facilities must operate with extraordinary reliability because customers may be running critical applications on them. If an online store fails, customers become angry. If critical cloud infrastructure fails, entire businesses can be affected. That's a different level of responsibility. And artificial intelligence makes the bill even larger. Advanced AI requires enormous computing resources. specialized accelerators, data center capacity, power, cooling, networking, research talent, software, models, infrastructure. The AI race isn't fought with PowerPoint presentations. It's fought with capital, billions of dollars of it. And as owner, you face a brutal question. How much do you invest? Too little, and competitors pull ahead. Too much, and you may build expensive infrastructure faster than profitable demand arrives. Then comes entertainment, Prime Video, sports rights in some markets, original productions, licensing, studios, technology, distribution. A customer sees a television show, you see contracts, production risk, marketing, content costs, and another battle for attention against some of the biggest entertainment companies in the world. Why do it? Because Prime isn't simply about video. Video can strengthen membership. Membership can strengthen shopping behavior. Shopping behavior strengthens the marketplace. Again, one business supports another, but support isn't free. Then comes grocery, physical stores, fresh food, spoilage, cold chains, local competition, thin margins, complex inventory. A book can sit on a shelf. A strawberry cannot. The moment you enter grocery, time becomes part of inventory economics. Products expire, demand shifts, waste matters. And now your trillion-dollar technology empire is worrying about bananas turning brown. That's Amazon. So, let's add everything together. The acquisition price, the takeover premium, financing costs, regulatory battles, fulfillment centers, robotics, sortation, delivery stations, aircraft, vehicles, data centers, AI infrastructure, cybersecurity, employee compensation, returns, fraud prevention, entertainment, grocery, hardware, research, acquisitions, inventory systems, seller support, customer service, global compliance, and the constant cost of making tomorrow feel faster than today. By now, the real economics become clear. Buying Amazon may cost trillions, but keeping Amazon requires continuous capital, continuous execution, and continuous reinvention. Yet despite all of this, despite the warehouses, the workers, the servers, the aircraft, the returns, the billions spent building infrastructure, Amazon has created multiple extraordinary money-making machines. Which raises the next question: where does the profit actually come from? Because the most important business inside Amazon may not be the business that sends boxes to your house. And that's where Chapter 3 begins. You've done it. You own Amazon. The acquisition is complete. The headlines have faded. The lawyers finally go home. You wake up on your first full day as owner, and before breakfast, millions of transactions have already begun moving through your empire. A customer orders coffee. Another buys a laptop. A company rents cloud computing power. A seller pays for advertising. A family renews Prime. A developer launches software using AWS. A brand pays for better visibility. A customer streams a movie. Different transactions. Different businesses. Same owner. You. Now comes the question that matters. How do you make your money back? Let's start with the business everyone knows. Online retail. A customer searches for a product, clicks, pays. The box arrives. Simple. Except economically, there are several different versions of that transaction. Sometimes Amazon may sell products directly. It acquires inventory, stores it, prices it, sells it. That looks more like traditional retail. Buy at one price, sell at another. Keep the difference before expenses. But retail has a problem. Margins can be unforgiving. Warehousing costs money. Shipping costs money. Returns cost money. Discounts cost money. Inventory that doesn't sell costs money. So, if you think Amazon became one of the world's most powerful businesses simply by buying products and reselling them, you're missing the deeper machine. Now imagine a different transaction. A third-party merchant sells the product. The seller owns the inventory. The seller wants access to customers. Amazon provides the marketplace. Now the economics change. Instead of making money only from the difference between wholesale and retail price, the platform can earn fees connected to transactions and services. The merchant gets access to demand. Amazon gets paid for facilitating parts of the relationship. That's the marketplace model, and marketplaces can become incredibly powerful. Why? Because of a flywheel. More customers attract more sellers. More sellers increase selection. More selection can improve the customer proposition. A stronger customer proposition attracts more customers. More customers attract more sellers. Round and round. The machine strengthens itself. This is one of the most important economic ideas behind Amazon. The company doesn't simply want to sell you a product. It wants to become the place where buying begins. Now imagine you're a small merchant. You make kitchen accessories. You could build your own website, find customers, run advertisements, handle payments, store inventory, pack boxes, negotiate shipping, manage returns, provide customer service. Or you could access a marketplace where customers are already searching. That access is valuable, and valuable access can be monetized. Then comes fulfillment. Suppose you're a seller. You don't want to pack every order yourself. So inventory can be placed into Amazon's fulfillment network under applicable programs. When customers order, the network helps handle storage, picking, packing, shipping, and parts of customer service. Think about what just happened. Amazon isn't merely hosting your product listing. It can become part of your logistics department. Now the company can earn money from services surrounding the sale. The marketplace creates demand. Fulfillment supports delivery. Prime can strengthen customer expectations. Advertising improves visibility. Each layer feeds another. And this is where Amazon becomes difficult to classify. Is it a retailer? Yes. A marketplace? Yes. A logistics provider? In important ways, yes. An advertising platform? Absolutely. A cloud company? Definitely. The mistake is trying to understand Amazon as one business. It's better understood as an ecosystem of economic engines. Now let's talk about advertising. Imagine you search for wireless headphones. You are not casually browsing the internet. You may be ready to buy. That makes your attention extremely valuable. Brands know this. Sellers know this. Competitors know this. Everyone wants visibility at the moment purchase intent is high, so they pay. Now, think about the beauty of this model. The customer came to shop. The sellers came to sell. Amazon sits between them. And visibility becomes another product. You're no longer earning only when an item sells. You're also monetizing competition for attention around the sale. Imagine a crowded physical supermarket. 10 brands want the best shelf. The shelf at eye level is more valuable than the shelf near the floor. Online, search placement can become the shelf. And when millions of customers search every day, digital shelf space becomes an enormous business. That's advertising. Then comes Prime. At first glance, Prime looks almost irrational. Offer customers fast delivery, entertainment, various benefits. Keep investing. Why? Because Prime can change behavior. Once someone pays for membership, they may begin checking Amazon first. Why pay shipping somewhere else? Why wait longer? Why create another account? Why search 10 websites? Convenience becomes habit. Habit becomes frequency. Frequency becomes revenue. That's the deeper economics of membership. A Prime customer isn't valuable only because of the membership fee. The bigger question is, how does membership change the customer's lifetime behavior? If they shop more frequently, stay longer, use more services, and become less likely to begin elsewhere, then the subscription has done something more valuable than generate a fee. It has strengthened the ecosystem. Now, we reach the business that changed Amazon forever. Amazon Web Services. Imagine it's the early days of a startup. You need servers, storage, databases, computing capacity. Traditionally, you might buy hardware, install it, maintain it, guess future demand, spend heavily before knowing whether customers will arrive. Cloud computing changes that. Rent what you need, scale when demand grows, Reduce some burdens of owning physical infrastructure yourself. For startups, that's powerful. For large corporations, also powerful. And for Amazon, it's a completely different economic engine. Think of AWS like a gigantic digital utility. A business needs computing. It consumes services. It pays. As demand changes, usage can change. Now multiply that across startups. Enterprises, developers, public sector customers, and organizations around the world. Suddenly, you're not selling books. You're renting pieces of the infrastructure behind the digital economy. And here's why that matters. Retail can be brutally competitive. Physical products must move. Warehouses must operate. Packages must travel. Cloud economics are different. Not easy, not cheap, but different. Customers can build deeply around infrastructure, applications, databases, security systems, workflows. Once a large organization builds significant systems around a cloud platform, moving everything elsewhere can become difficult, technically difficult, operationally difficult, expensive, risky. That can create durable customer relationships. Then comes AI, and AWS becomes strategically even more important because artificial intelligence needs infrastructure, computing power, specialized hardware, storage, networking, developer tools, model access, enterprise systems. If AI demand continues expanding, the companies providing infrastructure may capture enormous value. Remember the gold rush idea from our car manufacturing episode? Sometimes, selling shovels can be more attractive than digging for gold. In an AI boom, cloud infrastructure can become part of the shovel business. Then, there's subscriptions beyond the obvious shopping transaction. Membership, digital content, services, different forms of recurring relationships. Recurring revenue matters because it can be more predictable than convincing the same customer to make a fresh decision every day. You wake up, and some customers are already connected to an ongoing relationship. Investors tend to value that. Then comes physical grocery. At first, it seems unrelated. Why would a technology company care about groceries? Because grocery shopping is frequent. People don't buy a television every week, they do buy food repeatedly. Frequency matters. If Amazon can become part of routine purchasing behavior, the customer relationship deepens. But as we saw earlier, grocery economics are difficult, so the strategic value must be weighed against operational complexity. Then come devices: Kindle, Fire TV, Echo and Alexa-related hardware. Other products. Again, why sell hardware? Sometimes the hardware isn't only the destination. It can be a doorway. A Kindle connects customers to digital books. A Fire TV device connects users to content. A smart speaker can connect households to services. The device can strengthen the ecosystem. Sound familiar? It's a different version of the strategy we saw with Apple. But Amazon's ecosystem is built around a different center of gravity: commerce, services, infrastructure, convenience. Now step back. As owner, you begin to see the full machine. Retail attracts customers. The marketplace increases selection. Sellers create transactions. Fulfillment can support sellers. Prime strengthens loyalty. Advertising monetizes attention. AWS provides cloud infrastructure. AI creates new demand for computing. Entertainment supports engagement. Devices create access points. Grocery increases purchase frequency. One company, multiple economic loops. And here's the most fascinating part. Some businesses can tolerate lower profitability if they strengthen more profitable businesses elsewhere. A benefit may look expensive in isolation, but makes sense if it increases loyalty. A content investment may look strange, but makes sense if it reduces membership cancellations. A logistics investment may look enormous, but makes sense if faster delivery increases shopping frequency. This is why analyzing Amazon one division at a time can miss the bigger picture. The businesses interact. But now comes the danger. Because complexity is powerful until it isn't. What happens when regulators say, The marketplace has too much power. What happens when sellers decide fees are too high? What happens when a recession weakens consumer spending? What happens when a rival undercuts AWS? What happens when AI changes how people search for products? What happens when workers demand better conditions? What happens when one-day delivery becomes an expectation customers refuse to pay extra for? What happens when the infrastructure built for speed becomes too expensive to maintain? Suddenly, the flywheel can face friction. And that brings us to the billionaire decision. Because making money with Amazon is one thing, keeping this machine dominant is something else entirely. By now, you've seen why Amazon became so powerful. Customers attract sellers. Sellers increase selection. Selection attracts customers. Prime strengthens loyalty. Advertising monetizes attention. Fulfillment turns infrastructure into a service. AWS rents computing power. AI creates another battlefield. From the outside, it looks unstoppable. But history has a warning for every dominant company. Scale does not eliminate risk. Sometimes, scale magnifies it. Let's begin with the most obvious threat: regulation. The larger Amazon becomes, the harder it is for governments to ignore. Think about the questions regulators can ask. Does Amazon have too much influence over online commerce? Can it compete fairly while also operating a marketplace used by independent sellers? How should seller data be handled? Are platform rules fair? Does cloud concentration create systemic risk? Could acquisitions reduce competition? How should digital advertising be regulated? What about labor practices, consumer protection, data? At Amazon's scale, almost every major decision can become political. And here's the billionaire problem. Some of Amazon's greatest strengths can also attract the greatest scrutiny. A massive marketplace is valuable because so many buyers and sellers participate. But that scale creates power. A vast logistics network creates speed, but it can also raise concerns about market influence. AWS creates extraordinary infrastructure, but cloud concentration can make governments nervous. The stronger the empire becomes, the more people ask whether it has become too strong. Then comes competition. Most people think Amazon competes with retailers. It does, but that's only the beginning. In commerce, it competes with major retailers and digital marketplaces. In cloud computing, AWS faces formidable technology rivals. In advertising, it competes for budgets that could go to search engines, social platforms, retailers, and other media. In entertainment, it competes for attention. In grocery, it faces companies with decades of physical retail expertise. In AI, it faces some of the richest and most technically advanced organizations on Earth. Owning Amazon means fighting multiple wars simultaneously, and that creates a capital allocation problem. Suppose you have another $50 billion to invest. Where does it go? More fulfillment capacity? AI infrastructure? AWS? Lower prices? Entertainment? International expansion? Robotics? Advertising technology? Acquisitions? Every dollar placed in one area is a dollar not placed somewhere else. At small companies, a bad investment hurts. At Amazon, a bad strategic bet can burn billions before anyone admits it failed. Then comes the physical network. Remember the advantage? Fast delivery. Now look at the risk. Warehouses are fixed assets. Delivery stations are fixed assets. Aircraft commitments matter. Vehicles matter. Infrastructure matters. Suppose demand grows rapidly. You expand, build capacity, hire, lease, invest. Then demand slows. The customer disappears. The building doesn't. That's operating leverage, and it can be brutal. When volume rises, infrastructure can become more efficient. When volume falls, the same infrastructure can become a burden. Imagine building a massive fulfillment network for a future that arrives slower than expected. Now you're paying for buildings, maintenance, technology, labor, utilities, transportation capacity. all while packages aren't moving through the system at the volume you anticipated. That's the danger of forecasting. Amazon isn't only predicting what customers want to buy, it is making capital decisions about where future customers will live, how much they'll spend, and how quickly they'll expect delivery. Get that wrong, and the mistake is made of concrete. Then comes labor. This is one of the most politically sensitive risks. A vast physical network requires people, warehouse workers, drivers and delivery partners, technicians, managers, corporate employees, engineers, customer service teams, many different arrangements across many markets. Now imagine wage pressure rises, labor organization increases, regulations change, worker shortages appear, safety requirements tighten. Every small increase in cost, multiplied across a huge network, can become enormous. Scale cuts both ways. A $1 cost increase sounds small. Multiply it by enough hours, enough workers, enough locations, and suddenly, it's a major financial event. Then comes the customer, perhaps the most dangerous person in the entire empire. Because Amazon has trained customers to expect convenience, fast delivery, large selection, easy returns, competitive prices, reliable service. That's wonderful, until expectations become permanent. Yesterday's miracle becomes today's minimum. Two-day delivery once felt extraordinary. Then faster options became expected. The better you train customers, the harder it becomes to impress them. And if you slow down, they notice. If prices rise, they notice. If returns become difficult, they notice. The company becomes a victim of its own standards. Then comes the marketplace seller. Sellers need customers. Amazon can provide access. But sellers also worry about costs, fees, advertising expenses, competition, platform rules, margins, dependence. Imagine building your entire business on someone else's marketplace. Then the rules change. That creates tension. As owner, you need sellers. More sellers can mean more selection. But you also want to monetize the platform. Push too hard, and merchants become frustrated. Monetize too little, and you leave money on the table. Again, the decision is balance. Then comes AWS, one of the crown jewels. But cloud computing is not a monopoly. Competition is intense. Microsoft has Azure. Google has major cloud and AI capabilities. Other providers compete in different markets and specialties. Customers may adopt multi-cloud strategies. Technology changes. AI workloads evolve. Custom chips matter. Pricing matters. Reliability matters. Security matters. And enterprise customers negotiate hard. AWS may be powerful, but power must be defended. Now imagine the AI race accelerates. You invest tens of billions in infrastructure, specialized chips, data centers, power capacity, research, developer tools. Then, a new technical breakthrough dramatically reduces the cost of running advanced models. Or a competitor creates a better platform. Or customers prefer models that run increasingly on local devices. Suddenly, your assumptions change. This is the terrifying thing about technology investment. You build physical infrastructure for a technological future that can change faster than concrete can. Then comes cybersecurity. Amazon sits at the intersection of commerce and cloud infrastructure. That makes security existential. A customer account is compromised. Bad. A major marketplace breach? Worse. A critical cloud security failure? Potentially enormous. Customers trust the company with transactions, business systems, data, infrastructure, and services. The larger the trust relationship, the greater the consequences when trust breaks. Then comes AI from another direction, not infrastructure, shopping behavior. Today, a customer may open Amazon, type "best laptop for video editing," search, compare, click. But imagine an AI agent does the shopping. The customer says, "Find me the best laptop under $1,500, check reviews, compare warranties, and buy it." Now, who controls the customer relationship? Amazon, the AI assistant, the operating system, the browser, the payment provider? If AI agents become powerful intermediaries, the front door to commerce could change. And if Amazon loses control of the starting point, its economics could change with it. This may be one of the biggest long-term questions. Amazon spent decades trying to become the place where product searches begin. But what happens if people stop searching? What happens if they simply ask? That's not a small interface change. It could reshape advertising, product discovery, seller visibility, customer loyalty, the entire marketplace. As owner, you can't ignore that. Then comes geopolitics. Amazon operates across borders. Cloud infrastructure intersects with national security concerns. Data rules vary. Tax systems vary. Labor laws vary. Competition laws vary. Content rules vary. A strategy that works in one country may be restricted in another. You aren't running one Amazon. You're navigating many versions of the world. Now return to the original phone call. 6:17 in the morning. The banker, the offer. Several $1 trillion. Would you still buy? Let's think like a billionaire. You wouldn't ask, will people keep shopping online? Probably. You'd ask harder questions. Can Amazon preserve customer loyalty as AI changes discovery? Can AWS defend its position through the next computing revolution? Can the company keep delivery fast without allowing logistics costs to overwhelm margins? Can it monetize sellers without driving them away? Can it survive serious regulatory intervention? Can management allocate capital across so many businesses without losing focus? And perhaps the biggest question, is Amazon's complexity an advantage or eventually a weakness? Because that's the strange thing about empires. The same size that makes them powerful can make them difficult to control. The same infrastructure that creates a moat can create fixed costs. The same marketplace that creates network effects can attract regulation. The same cloud platform that creates profits can attract formidable competitors. The same convenience that builds loyalty can create impossible expectations. Every advantage has a shadow. But here's what makes the decision difficult. Amazon also has something many companies desperately want: options. If one retail category slows, the marketplace remains. If direct retail faces pressure, advertising may grow. If commerce matures, AWS can expand. If cloud computing evolves, AI can create new demand. If customers become more valuable, Prime can deepen relationships. If sellers need more support, fulfillment services can matter. Amazon doesn't have one path forward. It has many, and optionality is valuable. So after everything we've learned, the decision becomes much harder. You're not simply buying online shopping. You're buying the cost of fulfilling online shopping. You're not simply buying Prime. You're buying the obligation to keep Prime valuable. You're not simply buying AWS. You're buying a permanent technology race. You're not simply buying a marketplace. You're buying the political scrutiny that comes with controlling one. You're not simply buying speed. You're buying the infrastructure required to maintain it. And yet, you're also buying one of the most extraordinary collections of economic engines ever assembled under one corporate roof. So now, only one question remains. After spending several $1 trillion, would owning Amazon actually be one of the greatest millionaire decisions in history? Or would you be buying the world's most complicated machine at exactly the moment technology is preparing to rewrite commerce again? It's time to make the final decision. So, let's return to where this story began. It's 6:17 on a Tuesday morning. You're asleep. Your phone rings. You ignore it. It rings again. You answer. On the other end is the investment banker. The same voice, the same offer. Amazon is available. Several $1 trillion. At the beginning of this video, the decision sounded obvious. Now, it doesn't. Because now you know what you're really buying. You're buying one of the world's most powerful online marketplaces. But you're also buying the sellers who may resent depending on it. You're buying a logistics network built for speed. But you're also buying the enormous cost of keeping that network moving. You're buying Prime, but you're also buying the obligation to keep adding enough value that customers continue renewing. You're buying AWS, but you're also buying a permanent war against some of the richest technology companies on Earth. You're buying advertising, but you're also buying the possibility that AI changes how products are discovered. You're buying scale, but you're also buying every problem scale magnifies. So the question is no longer, can you afford Amazon? The real question is, can you afford to keep the flywheel turning? Let's do the math. Suppose you acquire Amazon at a valuation measured in the trillions. For simplicity, we'll ignore the exact market price on any particular day. We'll ignore the acquisition premium, the financing structure, the legal battles, the regulatory negotiations. Just imagine, several $1 trillion, deal complete. Now what do you own? A company capable of generating enormous annual revenue, a massive customer base, a global marketplace, a huge fulfillment network, a powerful membership ecosystem, a major advertising business, one of the world's most important cloud platforms, and strategic exposure to artificial intelligence. That's extraordinary. But remember our rule from Apple. Revenue is not your return. Profit matters. Cash flow matters. Reinvestment matters. And above all, the price you paid matters. Amazon can generate astonishing sales, but not every dollar of revenue is equally valuable. A dollar of low-margin retail revenue is economically different from a dollar connected to high-value advertising. A dollar generated through cloud infrastructure has different costs and strategic characteristics from a dollar generated by shipping a physical product. This is why simply looking at total revenue can mislead you. As owner, you care about the mix. Where is growth coming from? Where is cash being generated? Which businesses require enormous capital? Which businesses strengthen the others? That's the real analysis. Imagine the retail operation generates huge sales, but requires constant spending, warehouses, transportation, returns, labor, technology, inventory. Then, imagine advertising grows because sellers compete for visibility, or cloud services expand as businesses demand more computing power. The company's economics can change, even if the public still thinks Amazon delivers packages. That's why owning Amazon is fascinating. The most visible business is not necessarily the entire investment thesis. Now let's ask the billionaire question. Would you pay several $1 trillion for it? First, let's examine the strongest argument for saying yes: the flywheel. Customers attract sellers. Sellers increase selection. Selection can improve the customer experience. Better customer experience attracts more customers. More customers attract more sellers. More seller competition can improve availability and value. Prime can strengthen loyalty. Fulfillment can improve convenience. Advertising monetizes attention. The system reinforces itself. When a business has genuine reinforcing loops, growth can become more defensible. That's valuable. Second, customer habit. Think about the last time you needed something small. A cable, a book, a household item. Did you visit 10 websites? Or did you check one familiar place first? Habit is powerful. The company that becomes the default starting point doesn't need to win the customer from zero every day. It begins with familiarity, and familiarity reduces friction. Third, marketplace economics. A traditional retailer must choose what to stock, buy inventory, take risk, hope it sells. A marketplace can allow vast numbers of outside sellers to bring additional selection and inventory risk into the ecosystem. That doesn't eliminate Amazon's costs, but it creates a different model. The platform can benefit from economic activity it did not manufacture itself. That's powerful. Fourth, AWS. This may be one of the strongest reasons the entire company deserves serious attention. Cloud infrastructure places Amazon inside the operations of other businesses. A retailer sells to customers. A cloud platform can become part of how customers themselves operate. That's a deep relationship, and if AI expands demand for computing infrastructure, the strategic importance could become even greater. Fifth, Advertising. Amazon possesses something advertisers love: intent. A person scrolling through random entertainment may or may not want to buy something. A person searching for best noise-canceling headphones is much closer to a transaction. That makes attention valuable. And because sellers already compete inside the marketplace, advertising becomes a natural extension of commerce. Sixth, optionality. This may be the hidden advantage. Amazon can make bets. Some fail, some succeed. But the company has multiple platforms from which new businesses can emerge: commerce, cloud, logistics, devices, subscriptions, AI, advertising. A weaker company gets one major decision wrong and dies. Amazon can survive mistakes. That matters. But now, the argument against buying. First, the price. A great company is not automatically a great investment. If you overpay, future returns can disappoint, even if the company continues performing well. This is the lesson that appears again and again across Millionaire decisions. Quality matters, but price matters too. You can buy the best building in the city at such an absurd price that the investment no longer makes sense. Second, capital intensity. Parts of Amazon require enormous physical investment: fulfillment centers, data centers, transportation capacity, technology infrastructure, AI. The machine consumes capital, and the future may require more. Owning Amazon isn't about sitting back and collecting checks. You keep investing, because competitors keep moving. Third, regulation. The more central Amazon becomes to commerce and infrastructure, the more political scrutiny it may face. Marketplace rules, competition, acquisitions, data, labor, cloud infrastructure, taxes. Every major market can create different challenges. A regulatory change may not destroy Amazon, but when you paid trillions, even partial changes matter. Fourth, AI disruption. This is the wild card. AI could strengthen Amazon enormously. More cloud demand, better logistics, smarter recommendations, more efficient operations, new shopping experiences. But AI could also change the front door. If consumers delegate purchasing decisions to independent AI agents, who controls discovery? Who controls advertising? Who controls the customer? The winner isn't predetermined. Fifth, complexity. Amazon is a retailer, marketplace, cloud company, advertising platform, logistics network, subscription ecosystem, entertainment company, grocery operator, AI investor. At some point, diversification can become distraction. The question is whether management can continue allocating resources intelligently across an empire this large. So, who should own Amazon? If you're looking for a quick turnaround, probably not you. This isn't a broken corner store. You can't simply repaint the walls, cut 2 employees, and double profits. If you're looking for a simple passive business, definitely not. Amazon may be one of the most operationally complicated companies ever built. If you're planning to load the company with impossible debt, extract cash, and stop investing, you may destroy the very advantages you paid for. But if you're a patient owner, thinking in decades, the conversation changes, because then you ask different questions. Can global e-commerce continue expanding? Can Amazon remain a default destination? Can AWS capture future computing demand? Can AI strengthen cloud infrastructure? Can advertising continue monetizing commercial intent? Can logistics become more efficient through robotics and automation? Can Prime deepen customer relationships? Can the company survive regulation without losing the flywheel? If enough answers are yes, then the long-term economics remain extremely compelling. And this brings us to the biggest lesson. Amazon's greatest asset may not be its warehouses, not AWS, not Prime, not even the website. Its greatest asset may be the system connecting them. Think about it. A customer attracts a seller. The seller creates selection. Selection strengthens the marketplace. The marketplace creates advertising demand. Fulfillment improves convenience. Convenience strengthens Prime. Prime increases loyalty. Technology improves operations. AWS provides another enormous business engine. AI potentially strengthens multiple layers. Each part can feed another. That's what you're really buying. Not a store, a system. So, it's time. Millionaire Decision Scorecard. Investment required, 5-star extreme. A complete acquisition would be among the largest and most complicated corporate transactions imaginable. The public valuation would only be the starting point. A real buyer could face a substantial takeover premium, financing complexity, and extraordinary regulatory scrutiny. Score, 5 out of 5 for capital intensity. Profit potential, 5-star exceptional. Marketplace fees. Cloud computing. Advertising. Subscriptions. Retail. Fulfillment services. Digital products. AI infrastructure. Few companies possess this many major economic engines under one roof. Score, 5 out of 5. Risk level 4-star high, but diversified. Regulation, competition, labor pressure, capital intensity, AI disruption, cloud competition, cybersecurity, consumer slowdowns, marketplace tension. Amazon has enormous strengths, but also fights on more battlefields than almost any company on Earth. Score, 4 out of 5. Operational difficulty, 5-star extreme. You're managing physical goods, digital infrastructure, third-party sellers, warehouses, cloud customers, advertising, subscriptions, entertainment, global regulations, and a vast technology organization. Few businesses are harder to operate. Score, 5 out of 5. When? Time to recover investment. 2-star long. At a multi-trillion-dollar acquisition price, you are thinking in decades, not months, not a quick 5-year flip. The exact outcome depends heavily on purchase price, future cash generation, reinvestment, and growth. Score, 2 out of 5. Future outlook 5 stars, very strong, but uncertain at the edges. E-commerce remains deeply embedded in modern life. Cloud computing remains strategically important. AI could create enormous infrastructure demand. Digital advertising around purchase intent is powerful. And Amazon retains multiple ways to grow, but regulation and technological disruption remain serious. So, would owning Amazon be a millionaire decision? The answer is yes, but with the same warning that follows every great empire: price and execution. Because Amazon may be one of the most extraordinary businesses ever built. That doesn't mean any purchase price makes sense. If you overpay, the greatness of the company may not rescue your returns. If you bury it under debt, you could weaken its ability to invest. If you stop funding infrastructure, competitors catch up. If you exploit sellers too aggressively, the marketplace weakens. If you disappoint Prime members, loyalty fades. If AWS stops innovating, cloud customers gain alternatives. If you miss the AI transition, the future changes without you. But if you acquire Amazon at a rational price, maintain financial discipline, continue investing in technology, protect customer trust, keep sellers engaged, defend AWS, and allow the flywheel to keep turning, then yes, owning Amazon could be one of the most extraordinary long-term business investments imaginable. Not because it sells everything, but because it has found ways to make money from nearly every layer surrounding the transaction. The product, the seller, the fulfillment, the membership, the advertisement, the infrastructure, the data center, the computing demand, the ecosystem. That's rare, and perhaps that's the real lesson. At the beginning of this video, we asked what it would cost to own Amazon. Several $1 trillion? Maybe more after a takeover premium? But after everything we've learned, the real cost isn't the purchase price, it's the promise. The promise that when a customer clicks, the system works. The promise that the package arrives. The promise that the cloud stays online. The promise that sellers find customers. The promise that Prime remains valuable. The promise that tomorrow will somehow be faster, smarter, and more convenient than today. Because if you buy a steel factory, people expect steel. If you buy a car company, people expect cars. If you buy Apple, people expect the future. But if you buy Amazon, people expect everything. Cheap, fast, reliable, and preferably by tomorrow. So let's return one final time to that Tuesday morning, 6:17. Your phone rings. You answer. The banker is waiting. The papers are ready. The investors want a decision. Several $1 trillion. You look at the numbers. The warehouses, the aircraft, the robots, the sellers, the customers, the data centers, the cloud, the advertising machine, the regulators, the workers, the AI race, the promise of speed. And now, after everything you know, the banker asks, do we have a deal? You look at the contract and make your decision. If you enjoyed today's Millionaire Decision, hit the like button and subscribe for more deep dives into the economics behind the world's biggest companies, industries, and investments. And now, I want your verdict. If you had enough money to buy Amazon today, would you sign the deal? Or would you invest those trillions somewhere else? Tell me your decision in the comments below. And while you're there, tell me the next company or business you want us to put under the microscope. Because every empire looks simple from the outside, until you see what it actually costs to own one. Until next time, make smarter millionaire decisions.